The opinions expressed are those of the host. The material is for informational purposes only. It does not constitute investment advice, and it is not intended as an endorsement for any specific investment. Visit crestmontpw.com for more details.
Welcome to the Ascent. This is Sam McGee, CEO and owner of Crestmont Private Wealth. We have an office in Houston, Texas at 1 Riverway and an office in Boerne, Texas at 604 South Main. Today we're going to be talking a little bit about current events in the economy, in markets, and then we're going to shift over a little bit into income planning, retirement income planning, if you're living off the portfolio, and some things that you should care about if you're anticipating being retired or looking forward to retirement or you're in retirement. So let's first start off with some current events. We started the year with tariffs. We had the tariff tantrum. Market went down promptly, and then we had a pretty swift recovery, and ever since then we've had pretty reasonable and good, I would say, growth in the domestic stock market, and even the bond market has done pretty well. And I think this is pretty perplexing for a lot of listeners because they look at inflation, what it's been in the past. They take a look at a softening job market. We hear the news of tariffs and how they're impacting businesses. So why is it that the market has done so well? And I think the reason behind that is because the market is forward-looking. Think about the stock market, whether you're talking about the S&P 500, the Dow Jones Industrial, the Russell 2000, any index. Think about the stock market, the value of it as being a forward-looking, frame by frame of earnings in the future. That's kind of hard to kind of visualize, but think about those old flip chart books, those little cartoon books you can make, and just imagine you're flipping through it right now. I wish I could make that noise in the microphone, but you're flipping a book and you see this little character moving around. Those little frames are future earnings quarter to quarter to quarter. And what you're looking at in the value of a stock or an index or the stock market is forward looking. So sometimes the news around you can be mixed. It can be even not great, and the market could be going up. And hopefully that explains for some of you why that happens. Why that may be happening right now. Now, we've had quite a bit of lift in stocks with the AI boom, and we do see some pretty healthy valuations in the market right now on a price earnings multiple basis. But what we have today on a 1-year trailing basis is the S&P 500 total return up about 16.34%, and the Russell 2000 at 11.33 as of this recording, and then the Bloomberg U.S. aggregate, which is the bond market, up 5.58%. So what does that really mean? That means that we have weathered some of the storm of COVID. We've gone through a rate increase cycle by the Fed, and now we're in a decreasing cycle, and we're in a place of uncertainty, and that's part of investing. You're really always in a place of uncertainty as an investor. So let's talk about current events. So right now, when we take a look at what's happening at the Fed. Now, remember, the Fed, their job is to shift interest rates, short-term rates, based off what's happening with inflation versus what's happening in the economy. So we talk a lot about this on this show. So if you have higher inflation, they're going to raise rates. If you have an overheating economy, they're going to raise rates. If you have a economy that's starting to soften, they're going to lower rates. If you have deflation, they're going to lower rates. So why would the Fed be lowering rates like they just did in a pretty healthy stock market? It's because they see some softening in the labor market right now. And so that is the primary reason, the softening of the job market relative to inflation, which is pretty under control right now. Currently, the U.S. Consumer Price Index year over year is at 6.45%, which is still relatively high, but it's come down from a high of 9.06 year over year percent change. And unemployment has upticked a little bit. We have U.S. unemployment rate currently at 4.3%, which is good, but really nowhere near where we were in 2023 at 3.6 in November of 2022. And it's just been kind of upticking since then. So the job market has softened a bit. So the Fed has cut rates. What does that mean for you, a listener? Right now, you're listening to this and you're going, okay, what does all this stuff mean for me? Well, if you are a U.S. consumer, which you probably are, and you have a U.S. bank account and you have a savings account or a money market account, it probably means your bank is going to be lowering rates. If you have a savings account that once had a 3.5 or 4.2% rate, that bank is probably dropping your rate as the Fed is dropping rates. So the earnings that you have on your cash is dropping. Okay, so important just to keep track of that and know why that's happening. And it also means that the Fed is actively trying to stimulate the economy because they see some fissures in the job market. Now, what does this all mean if you are a retiree and you're looking at healthy valuations on the market? You know, you've seen a pretty good year so far. We already mentioned some of those percentages in growth, and you're not working right now, or you're anticipating not working, and you're going to be living off the portfolio. I want to talk a little bit about asset location. Now, this is different than asset allocation and diversification. It's a slight nuance. Many of you have heard the importance of diversification, having a broad array of securities, whether it's stocks, bonds, mutual funds, ETFs, and a mix between stocks, bonds, and cash. The benefits of that come from those asset classes behaving differently in different markets. For example, if you have a really bad stock market, sometimes, not always, bonds can do better than stocks. Not always. Like in 2022, bonds were also down. But you want to have a broad array of assets. Now, asset location is very different. At Crestmont Private Wealth, when we talk about asset location, we're talking about the diversification of a portfolio having a lot of different asset classes. So when I talk about asset classes, we could be talking about real estate. We could be talking about stocks, bonds, cash, international stocks, developed market stocks, emerging market bonds, international bonds, U.S. bonds. See, I've already rattled off at least 6 asset classes here, and all of those perform a little bit differently in different markets, whether the market is up, it's flat, or it's down. Now, why would that matter if you're a retiree? And this relates to income planning. Let's say that I need $15,000 a month out of my portfolio, plus Social Security. Maybe I'm drawing out $3,500, $3,600 a month, and I'm drawing out $15,000 a month out of my IRA, as an example. Well, if you're in a rising stock market, and like this year, stock market has done pretty well so far, and you're taking that $15,000 out this month, would you rather take it out of an asset class that maybe has not done so well this year? Or would you like to naturally rebalance your asset allocation by taking money out of, for example, stocks that have done well? That is the importance of asset location. Asset allocation and asset location matter. So let's say that we're in COVID, and let's say it's the early days. Take yourself back to March of 2020. Now, you might have been more concerned about where you get toilet paper and, food and masks and Clorox at that time. But back then, Crestmont was very entrenched in being concerned about asset location. And I distinctly remember in the portfolios that month, before the Fed opened up all the stimulus and the lending programs, the number one performing asset class at that time right at the height of uncertainty in March was treasuries, U.S. treasuries, and then it was cash, and everything after that was basically down temporarily. And then there was a big V-shaped recovery on stocks later. Well, let's say you had that $15,000 you needed that month as a retiree. Where do you think you would pull that from? This gets back to the importance of broad diversification, asset allocation, having the right amount of mix of different asset classes in your portfolio, and having the asset location and the ability to be able to draw from it. So in that example, if I needed $15,000 and let's say I had a $5 million IRA, it'd be pretty easy just to pull that $15,000 from the outperformance of the U.S. Treasury in that month. And that's actually what we did for a lot of our retirees back then. It's kind of a unique nuance that I think a lot of retirees, when they're doing income planning, may not realize is that you don't have to take everything every month or every quarter or every year pro rata. And that gets back to the importance of making sure that you work with an advisor that is going to be flexible enough to be able to take from or trade securities in a more nimble way using the approach of natural rebalancing to a portfolio and utilizing what we call asset location, being able to pull from the cleanest shirt in a dirty pile of laundry or the shining star amongst many. And it's just that simple. It's when income planning comes around for retirees, this is the first thing that we will talk about is making sure that you have an income plan that fits for your lifestyle, is going to meet your expenses, beyond the taxes as well, and that you can sustain that. And then when it comes down to volatile markets, we want to make sure our clients understand that if they're broadly diversified, that we have the ability to be able to pull from or sell securities in different locations, different asset classes that perform differently in different markets. Now, I want to visualize this for some of you, because I think some of you I might have lost. It's a deep subject. Some of you are very into financial markets and some of you are not. I want to use a very basic example. My mentor told me this a long time ago. Diversification. Think about it like sales of ice cream or sales of umbrellas in Florida. So Florida rains a lot. It's also the Sunshine State. So you go to Florida and it's pouring rain, and it's in the middle of July. What do you think is going to sell more? Umbrellas at that time or ice cream? Probably umbrellas. You're there in July and it's scorching hot. You're sunburned. You just got off the beach. What do you think is going to sell more? Ice cream. Think about markets like weather. They're going to change. Things change all the time. But having different asset classes, having ice cream, umbrellas, and being able to capitalize on those for your needs, for your expenses in retirement is super, super important. I use that analogy because I think it's so basic for people to understand. We know it's going to rain. We know the sun is going to scorch. Ice cream and umbrellas are probably going to be here to stay. And when we look at portfolio construction, we want to have a number of different asset classes that are going to perform differently in different markets, whether it's sunshine or raining. I hope that this has been useful to you. If it has, and you'd like to reach out and get a review of your portfolio, please do that. We work with wealthy individuals that have $1 million and up in portfolio assets, typically wealthy individuals or those that are building wealth as well. We work with the entire family in a very unique billing structure from generation 1 through 4. And I think you could find us very easily at crestmontpw.com with a contact us page. I'm Sam McGee, CEO and owner of Crestmont Private Wealth. Have a wonderful weekend and God bless.